A very good morning to all of you students. Today we will be continuing our discussion on mergers and acquisitions. Good morning everyone. So before we start, I think the topic of business valuation is already covered, right? In the previous sessions. If anyone can confirm me. Okay, perfect. So taking that as a base, we will start with the discussion on the mergers and acquisitions. So, students, let's first discuss the different types and forms of mergers and acquisitions. Because if you really ask that what is one specific definition of merger and acquisition, there is none. There are different forms of mergers and acquisitions, right? So, let us discuss some of them. And the first one is the most commonly used form, in which, let's suppose there are two companies, A and B. Okay, so there are two different companies having two different legal identities. So B merges into A. Okay, so B is merging into A, and as a result, B's legal identity is dissolved. Post merger, B is not retaining its separate legal identity, and A continues as the merged entity. So A continues with whatever A was doing before merger, and A continues by taking over the activities of B company, which has merged into A. So A continues, students. I hope this form of merger is clear. So in this, one company is getting merged into another company, and the company that is getting merged into another company is losing its legal identity, and only one legal identity of the company which has taken over remains. Okay, this is the most commonly used, let's say, kind of a form of a merger. So this is actually a merger. If you really ask us, as the topic suggests, right, mergers and acquisitions. So this is merger, in which companies are getting merged. Clear? Then the second form, in this again there are two companies, let's say A and B, because if you're talking about mergers and acquisitions, in most of the cases there has to be two companies. So A actually acquires majority stake in B Limited. The moment A does that, what what will A become and what will B become? Can anyone tell me, students? If A Limited acquires majority stake in B Limited, what name should I call A Limited with and B Limited with? Come on, students, tell me.
A Limited will be holding company and B Limited will be subsidiary company.
Very good. So A Limited will become holding company, B Limited will become subsidiary company. Correct? And both of them will continue to have their own legal identity. So this will continue, right? Because there is no question of merge. There is no question of merger here. The companies are not getting merged. They are still separate. One is holding and another one is subsidiary. And can anyone tell me what is this situation called as? Like we put above as merger, what we can say this as?
Acquisition.
Action.
Yes, this is a acquisition because this has been acquired. So this form is called as acquisition. Clear? So this is another form of a merger and acquisition, right? Clear, between merger and acquisition, these are the two different forms. Now, the third form, wherein let's say A is having two different businesses, business 1 and business 2. Okay, so a company have two businesses, business 1 and business 2. And what happens? Subsequently, B1 is retained, with B1 is the business name. Okay, so this is business. Let's say this is a textile business, and let's say this is a perfume business. Okay, two different businesses, textile and perfumes. Now, for business 1, which is a textile business, the company A decides to keep it with it. So it is there in company A. And for the other business, the perfumes business, company A decides to transfer this to a new legally formed entity, B Limited. It decides to separate it out. And the reason is because they want it they want it to be under a specific focus. Clear? They want it to be under a specific focus, so that there is a specific company, there is a specific management, there are specific board of directors who are overseeing the functioning of the company, right? So this is B2, this is perfumes business. Now eventually what has happened, A has broken up into two different companies, A and B, having two different subsets of the businesses, which is textile and perfumes. So in B, what will happen? The B2 from A Limited to B Limited. So this transfer will happen. B2 will get transferred from A Limited to B Limited. Clear? So this is another form of reorganization, right? Business reorganization, business restructuring, in which now, sorry, yeah. So in this now, there are different companies who are taking over the different businesses. Can anyone tell me what type of form this will be called as? We discussed merger above, we discussed acquisition. Now, what kind of form of a merger and acquisition this will be regarded as? Come on, students, you can give it a try. Just try to think. Here, what we are doing. Yes, very good, Ankita. This is, sorry, this is demerger. Perfect. So this is called as demerger, in which you are doing a demerger of the single company into two or more companies. Then comes, let's say, the fourth form, wherein there are two companies, A and B. Okay. And how do they do the mergers and acquisition is they both of them get dissolved and they create a new company called C. So both of them gets merged, dissolved, and ultimately they form up a new company called C, in which the business gets transferred of A as well as B. So this is business transfer. Similarly, this is also a business transfer. Clear, students? Now comes the, and again this we will call as what?
Reconstruction.
Sorry?
Reconstruction.
Yeah, this is kind of a reconstruction only, but in terms of the terminology, we can call it as again merger. Okay, this is another kind of a merger. Okay, and Ojajini had also said about the amalgamation. See, amalgamation and merger are mostly the similar things, but amalgamation is a very wide term compared to merger. Okay, amalgamated means joining something, right? Now, this literally, yes, you are joining. Even merger also you are joining, right? And even acquisitions also gets covered under amalgamation. Okay, amalgamation is a very wide term. Now, next one is, okay, let's talk about now two companies, A and B. So A is having a business of perfumes and B is having two businesses, again B1 and B2. B1 is for the deodorants and B2 is for the soaps. Clear? Now there are three different businesses in two different companies. Okay? Now practically I have seen this kind of a business reorganization as well. Now what will happen in this? In this, A purchases from B. Now, if you see from A's perspective, which business is better to be purchased, deodorants or soaps? Come on, students, tell me. A is already is in the business of perfumes. From a business side, which business purchase would make more sense? Deodorant, yes. So A will pay the purchase consideration to B, and B will transfer the business of B1, which is deodorants. And then B will continue with the soaps business. So post this, B will continue with soaps business, and A will have two business lines, perfumes and deodorants. And whatever amount that B thinks is appropriate for the sale of deodorants business, A Limited will and B Limited will negotiate that amount, and ultimately that amount will get settled. So this is one of the business transfer arrangements. Okay, in this only the business is getting transferred, but the right valuation of business has to be assumed. So this is a case of business transfer. Okay, clear? I hope this is clear, students. Till now, if there is any query or question, please do let me know, because this is going to be the base of further discussions, students. Nothing is there. So let's continue then. So possibly these can be different types of the forms, or let's say different ways in which companies can rearrange themselves, reorganize themselves to enter into a merger or acquisition kind of a situation. Okay. Now let's come to the specific discussion on these parts. Now in the entire discussion, there will be one acquiring company and there will be one target company. This is called as target company, of whose business is going to be taken over, and A Limited is going to be called as acquiring company. And in the entire discussion, we have to come up with the right amount that this A Limited has to pay to B Limited's shareholders or owners. Correct? So, if you really ask, then let's take the first situation and let's take our discussion ahead. So, the first situation was what? There are two different companies. B merges into A. So, B Limited merges into A Limited, right? And the amount that A will pay to B is called as purchase consideration. Okay, so the terminology is called as purchase consideration. Now, can anyone tell me in what different forms or types this purchase consideration can be discharged and to whom it has to be paid? I am asking you two questions. In what ways and means this purchase consideration can be paid by A Limited, and who are the ultimate recipients of this purchase consideration? Very good. I have got an answer from Ankita. I'm waiting for more responses. Yes, Ankita, even that one is correct. Very good, Nisha. Yes, Ojasini. Yes, very good. I think I have got multiple responses now. I think most of you are correct. Now, hear me out. So, to answer the first question, A Limited can discharge the purchase consideration to B Limited in these different forms. First form can be equity shares of A Limited, right? Equity shares of A Limited issued to shareholders of B Limited. Clear? Because they cannot issue shares to B Limited. If they are going to issue the shares to another company, which is B Limited is going to get dissolved later on, right? And ultimately, the beneficial ownership in B Limited is held by the shareholders of B Limited, right? So they have the right to receive equity shares of A Limited in lieu of the equity shares of B Limited as shareholders of B Limited. Second can be a cash payment. By cash, we don't mean hard cash here. By cash, we mean through bank transfers, through outflow of the funds, right? Outflow of funds. And ultimately, who will be the recipient here? Again, shareholders of B Limited will be the recipient here. Then third one can be a combination of one and two students. Clear? Perfect. So these can be three different forms of payments under mergers and acquisitions. Now, for doing this, the basic question that comes to our mind is for doing the equity shares of A Limited to the shareholders of B Limited, what is the basic question that comes to our mind? The basic question is how many shares will be issued against how many shares of B Limited, right? So, what ratio should we use to issue the equity shares? Because let's say there are thousands of different equity shareholders of B Limited, and each of them are holding different number of shares. The answer is yes, they can hold. Now, in what proportion should we issue A Limited's shares to the shareholders of B Limited? In what ratio and in what proportion? So this is called as the swap ratio, right? Swap means for what amount of shares, for what number of shares B Limited shares will be exchanged against the A Limited shares. That is called as the swap ratio. So we call it as the what is the right swap ratio. Okay. In this case, for the cash payment, you just need to know that what is the value of payment, which will come from the valuation, right? And again, this we discussed, this plus this is equal to what the amount will be needed, right? Because last one is a combination. In whatever you do to arrive at the right swap ratio, to arrive at the payment, correct payment value, or the third one, whatever you do, you need to refer to the business valuation principles, students, right? Because see, ultimately, if I tell you that what number of shares of A Limited in exchange of what number of shares of B Limited, I need to know that what is the value of a share, right? Similarly, if I need to pay amount for purchasing a business, I need to know that what is the right value of that business. Clear? I hope the discussion is clear till now, students. So this is the biggest, let's say, negotiating factor, the swap ratio between two companies. Okay, perfect. So let's move ahead. Now let's discuss what are the steps in mergers and acquisitions. Sorry, from our discussion standpoint. See, first of all, we have to estimate A Limited's equity. Okay. Sorry, by equity I mean equity value. Second will be estimate B Limited's equity value. See, this is again coming from the valuation principles, right, students? From the business valuation principles. Third, then calculate the swap ratio. Okay. So, in a way, the question can ask you to calculate the swap ratio. For calculating the swap ratio, you need to know that what is the A limited's value, what is the B limited's value. Then only you will be able to calculate the swap ratio. And the last leg in this entire discussion will be post merger analysis. Clear? And in this entire discussion, we are saying that A Limited is the acquiring company and B Limited is target company. Okay, clear? Now, let's understand some of the formulas, some of the running formulas that we will be using in different situations. Okay, let's start with PE ratio. Come on, students, tell me, how do you calculate the PE ratio? I think you would have used this multiple times. How do you calculate PE ratio? Very good, Nisha, Ankita, both of you are correct. This is price divided by earnings ratio, or we also call it as MPS, market price per share, divided by EPS, earnings per share. Okay. Now, if we talk about swap ratio, this is very much important. So, if I have to calculate swap ratio, there are again different ways to calculate a swap ratio based on different metrics. So let's see, basis all these different metrics, how do we calculate the swap ratio? The first one will be MPS of B Limited divided by MPS of A Limited. Whatever this ratio comes out to be, this is called as swap ratio, and this we call as market price based swap ratio. So this will ultimately tell us that how many shares of A Limited will be issued against one share of B Limited. Clear? Clear? So this is the most commonly used swap ratio. Obviously, if you have the market prices, you will just divide them and arrive at what are the number of shares to be issued. The next one is based on earnings. EPS of B Limited divided by EPS of A Limited will give us again a swap ratio. This is based on the earnings. Then the next one, so sorry, even for the second swap ratio calculated, it will be telling you that what are the number of shares of A Limited to be issued against single share of B Limited, right? So this ratio again will tell you the same number. But yes, the swap ratio calculated in the first manner will not be equal to the swap ratio calculated in the second manner. So it will really depend on the negotiations between A Limited and B Limited. How do they want to proceed? Whether they want to use the MPS as the basis of swap ratio, EPS, or some other metrics, or a combination of one or two metrics, right? Using the weightages. Clear? Here we have book value per share of B Limited divided by book value per share of A Limited. Whatever this number comes out to be, this is again giving you a different type of swap ratio, right? Book value based. Okay, clear? And one more basis of calculating a swap ratio, which is more prevalent in case of banks or NBFCs, is basis on the NPA, non-performing asset, right? So here, if we use gross NPA percentage of A Limited divided by Gross NPA percentage of B Limited. Okay, this is gross NPA based. Now, students, has anyone noticed any change in this compared to the three previous ones? Yes, Ujasini, you're right. Anyone else also wants to express what is the change? Yes, Nisha, very good. So, the change here is that for calculating the again same swap ratio, here now the target company has gone into denominator. So, up till third, the target company was in the numerator and the acquiring company was in denominator, right? But now for the fourth part there is a change. Now if you think logically, so let's come to the first one. In this case, if market price of A Limited is higher than the market price of B Limited, then the swap ratio should be lower, right? And this is how the f- the formula that we have mentioned here will make sure that the swap ratio is lower, because higher the denominator, lower the ratio will be. Correct? I hope all of you agree with me. Similarly, in the second part, if the earnings per share of A Limited is higher than the earnings per share of B Limited, the swap ratio is again going to be lower, which is again denoted by the formula here, because if denominator is higher, the swap ratio will become lower. And just to give you a reverse argument, if earnings per share of B Limited is higher than the earnings per share of A Limited, then the swap ratio should be higher, right? Because I am getting some business or some company having higher earnings than my current earnings. So I should be willing to pay more. If I'm willing to pay more, the swap ratio should be higher. If the swap ratio is higher, that means here the numerator will be higher, which is what the fact is, right? Because EPS of B Limited is higher, it will drive the higher swap ratio, higher purchase consideration, and hence the deal will get completed. Clear? Similarly, for book value per share. But in case of gross NPA is not a good thing to have. It's a negative indicator, right? So if we put the same formula of gross NPA A Limited as the numerator, sorry, as the denominator, and in the numerator we would have put gross NPA B Limited, then what would have happened? I would have ended up paying higher swap ratio for getting higher NPAs, right? Which logically is not making sense. If the NPA in B Limited is higher, the swap ratio should be lower. So for doing that, NPA B Limited has gone into the denominator. I hope this is clear. So this NPA percentage will be used in one of the questions ahead. Okay. So please bear in mind, while we will be calculating the swap ratio basis NPA, we have to be watchful of this. Okay. Then EPS, how we calculate EPS? Earnings attributable to equity shareholders. Equity shareholders divided by number of equity shares, right? Clear, students? Yeah. Then comes EPS after merger. So the above one is a regular formula of EPS, right? How do you calculate EPS is given up the above formula. But sometimes the question will ask you to calculate the EPS after merger, or they can also call it as the post merger EPS. Okay. And just to remind all of you, this will be part of this post merger analysis. Okay. So, how it will be? In case the consideration is settled through shares. Okay, so there will be different ways to calculate post-merger EPS. It will depend on really how you settle the consideration, whether in the form of shares or whether in the form of cash. Here, let's take the example of shares. So what you will do, you will take the PAT of A Limited, which is profit after tax, PAT of B Limited, plus you will also do the synergy gain in case something is there available in the quotient, just take it, whole divided by equity shares of A Limited plus equity shares issued to the shareholders of B Limited. Correct? Clear? This will give you the post merger EPS in case of shares settled cases. Clear? So in the denominator we have taken both the count of the shares, and in the numerator we have taken the PAT amount. Then the second case is actually on the cash settlement. So through payment of funds. Again, PAT of A plus PAT of B plus there will be a synergy gain minus what we will do, cash paid, whatever is the cash outflow has happened, right? Because that amount has come out of the business now, right? So cash paid multiplied by return percentage multiplied by 1 minus tax rate. Correct? Because till this amount, your earning capability will go down, right? Till this amount, your earning capability will go down. This divided by the equity shares of A Limited. This will give us the EPS post merger of A Limited, where the settlement has happened through cash. Clear? Why we are reducing the cash paid into return percentage 1 minus tax? See, 1 minus tax we are doing obviously because this is the ultimate impact on PAT. We are talking about PAT, right? So in PAT, 1 minus tax has to be adjusted. Now return percentage, why are we are multiplying is to see that what is the future earning potential that we have lost because of paying out the cash from the business. Okay. Now, some of you might be asking, what is synergy? I hope so. Do all of you know what is synergy?
Benefit and get
Sorry, I cannot hear.
benefit that we get due to such acquisition. It can be in form of additional revenue, additional profit generating capabilities of network in future.
Yes, the voice is coming out to be very bleak, but I can understand it's the benefit on account of acquisition. Yes. See, first of all, this is very, very important because the questions will lot of time will ask you to calculate the post-merger EPS. Now, let me talk you through about the meaning of synergy, right? So, synergy, if we talk about value of A and B business put together, is always higher than the standalone value of A business and standalone value of B business. This is the merged entity. This is A limited and this is B limited. And this is also practically proven as well, because once the two companies merges, right, there are numerous benefits that keep on flowing. For example, now there will be a common board of directors, right? Earlier there were two different sets of board of directors, A limited and B limited. So you'll be able to save on that. There will be common management. Now there is no need of two different CEOs, CFOs, right? You will save cost on that. Then the supervisory layer will be reduced, right? Similarly, the overheads will come down, right? Some of the support functions, now there is only single team that will be able to handle it, right? Then let's say if both of them are into the similar line of business, so both of them will complement each other in terms of the way they do business, right? So let's say one was the supplier and second one was the customer. Now if both of them gets merged, so the entire value chain will come under one company, which will mean more profits and hence higher
You are not
valuation.
visible, sir. Your voice
Yeah.
was stuck in between.
Okay. So let me repeat. So what I'm saying is, okay, let me repeat the synergy concept. What I was saying is the combined value of A limited and B limited put together is lesser than the value of the merged entity. Or in other words, I can say that if the merger happens, the post-merger value of that business is always higher than the individual values taken a total together. Reason being, because the common functions, the common layer of the supervision, management, board of directors gets eliminated because now there is only one legal entity. That is point number one. Point number two, what I was saying, if let's say this A limited and B limited have a supplier customer relationship, correct? It might happen that they have a supplier customer relationship. In that case, now the entire value chain will come under one umbrella, right? And the profits, or let's say the profit element on account of the supplying effort, on account of the production effort, on account of the selling effort, will all come and consolidated under one company. And if the earnings go up, definitely the valuation is also going to go up. Okay. I hope it is clear now, students. Should we move ahead?
Yes, sir.
Perfect.
Sir,
Yeah.
in the earlier formula, why we have taken only A limited as denominator?
Through settlement of cash here.
Yes, yes, sir.
Yeah, because we are calculating the post-merger EPS. So after merger, B Limited is not there, right?
Yes, sir. Yes, sir. Clear, sir.
So hence we are taking only A Limited.
Yes, sir. Clear.
And the difference between first and second is in first, since we have issued additional shares that we have taken here, and in second there is no additional shares, hence we have taken the as is number of shares. Okay.
Yes, sir.
Now the next one is effect on EPS post merger. So sometimes the question might ask you to calculate the effect on EPS post merger. Okay. Now it can be from two different angles again. One is from the angle of acquiring company, which is A Limited. We can call it as acquirer also, or acquiring, whatever you want to say. So A Limited is the acquirer company. Why I'm saying acquirer? Because we are talking about post merger, right? So A Limited has acquired already. So we will use post merger EPS, whatever that value comes out to be, less pre merger EPS. Whatever the difference comes out to be, that is the net impact on acquirer company. Now here students, the point to be noted is, let's say 10 rupees is the EPS post merger, 8 rupees was the EPS pre merger, so 2 rupees becomes the impact on EPS post merger, right? Clear? So this was an easier one. Let's talk about the target company, which is actually B Limited. Okay. So here it will be post merger EPS of which company, students? Tell me. Post merger EPS of which company should I take?
A limited.
Yes, because B Limited is not there. B Limited has already been dissolved. So we'll take post merger EPS of A Limited. But is it okay to take it as is? No, because it has to be adjusted for swap ratio. Okay. See, if I take the post merger EPS of A Limited as is and compare it with the pre merger EPS of B Limited, then I'm making a very big mistake, because I am assuming here one share of B Limited was exchanged for one share of A Limited, which is not the case. It was adjusted for the swap ratio, right? So, first of all, we have to say that what is the post merger EPS of B Limited's equivalent value in A Limited, which is again calculated by using it against the swap ratio adjustment, right? So that will give us the net impact on the target company's EPS. The reason why we are doing is this adjustment. One share of A Limited post merger is not equal to one share of B Limited pre-merger. Clear, students? Then it will be a like-to-like comparison. Okay. So this was the effect on EPS post-merger, both from A Limited's perspective and B Limited's perspective. Then comes, so sometimes the question might ask you to calculate the value of acquisition. And this can come from A Limited's perspective. Okay, so value of acquisition, because acquisition is done by whom? A Limited, right? So from A Limited's perspective, the value of acquisition will become value of merged entity minus value of acquiring company before merger. Correct? So let's say post merger, what has the value become of that merged entity minus before merger, what was the value of acquiring company, which is A Limited, right? Yes.
Does it equal to synergy benefit or synergy gain?
No, no, this is not synergy gain. This is not synergy gain. Let me explain you how. Okay. So this is value of merged entity, which is AB minus A, right? What is the synergy benefit? AB minus A minus B. Clear? So if you do that,
Yes.
then you will be able to arrive at the synergy benefits. The next one is, sometimes the question might ask you to calculate the gain or loss to shareholders. So you're discussing all the formulas at length. Later on, we will not be struggling to find them and understand them and apply them. We will just practice many questions to firm up our understanding. Now, the gain or loss to shareholders can also happen in two different perspectives or in two different views. One is from A Limited's standpoint, right? So, what is the gain or loss to the shareholder of A Limited? The post merger value of the share minus pre merger value of the share, right? So, MPS of post merger A Limited minus MPS of pre merger A Limited. right? Whatever we arrive it at, if it is a positive one, it will be a gain. If it is a negative one, it will be a loss. Clear? Then let's come to B Limited. MPS of post merger A Limited, right? But this will be again adjusted for swap ratio, because here also we would have issued different number of shares of A Limited against the different number of shares of B Limited, right? So here also the swap ratio will get adjusted to arrive at the equivalent value of post merger of A Limited MPS minus MPS of pre-merger B Limited, right? Again, gain slash loss. We will be able to arrive at the same. Clear, students? So sometimes the gain or loss to the shareholders can be calculated via this technique. Now there is a term called market capitalization. I think most of you would know this. Market capitalization is what? Market price per share multiplied by,
Number of shares outstanding.
yes, number of equity shares. Now there is a term called promoter holding. So promoter holdings is generally, let's say, 50%, 60%, 70%, whatever is the overall promoters holding, that comes as the number of equity shares. Okay. So let's say 60% of the number of equity shares is held by promoters. So out of the overall market cap, 60% is held by the promoters, is what we will say. But the total market cap will include promoters holding. So let's say I'm saying 60%, or I can say that any X percentage, right? Whatever is given in the question. Now there is a term called free float. Okay. Free float market capitalization is equal to overall market capitalization multiplied by 1 minus X percentage. Means 1 minus promoter holding, if we do. So free float means apart from promoter, what value of the market cap can be free floated. Free floated means freely purchased or sold, because promoter holdings generally will not get diluted. See, promoter holding means, let's say, for if we take an example of Reliance, right? So whatever shares are held by Ambani's will be taken as promoter holding, and even in financials, it is imperative. It is necessary to disclose the promoters holding, right? So from there we can arrive at what is the percentage of the promoters holding, and that if we reduce from the overall market capitalization, we will be able to arrive at the free float market capitalization. Now I was reading one very interesting article. Okay, now let's complete this and then I will talk you through that article. I just wanted to share that. Before that, just two more formulas and then we will discuss about that article. Okay. So then comes the true cost of merger. This is the true cost of merger. So cost from the perspective of A Limited. So if A Limited is incurring a cost, that means B Limited is having a gain, right? So gain to shareholders of B Limited, which is the target company, right? Value of merger will be what? Gain to the shareholders of A Limited. Which is the acquiring company students. So these are the two more formulas that I wanted to discuss with you. Okay. So with this, I think overall discussion we end up with on the formulas, concepts, whatever most of the things are going to be asked in the questions we have tried to capture here in the first half of the session. Now, the interesting thing that I was going to talk about is this article that I read yesterday only. So, interestingly, HDFC Bank and Reliance as a group. Okay. So, I'm just talking, let's say HDFC Bank have a 165 billion market cap. Okay. And Reliance have a 200 billion market cap, right? I'm just taking 3-4 minutes to discuss about this. This I'm talking about the market capitalization. Okay. 165 billion and 200 billion. Now, all of you would be able to know that the Sensex or Nifty is comprising of, let's say, Sensex comprises of the top 30 companies by market cap, and their movements is coming into that index that we call as Sensex. And Nifty takes top 50 companies to arrive at the Nifty index, right? To say that these are the movements of the Nifty index, and hence these are the direction in which the Nifty or Sensex is moving, right? So now, interestingly, according to this data till now, Reliance movement in prices, and let me tell you, both HDFC and Reliance, both of them are in top 30 and top 50 companies respectively on both Nifty and Sensex. Okay. Now, if you really ask that 200 billion is the market cap of Reliance and 165 billion is the market cap of HDFC, so the impact on Sensex and Nifty should have been created more by Reliance, right? Because they are having a higher market cap. But in reality, it is not so. Why? Because they don't see the market cap for the top 50 or top 30 companies. They take the free float market cap. And here, 50% of the holding is held by promoters. The moment this fact comes, the entire situation changes now, right? Now it will become 100 billion, right? This is the free float market cap. And this one, let's say whatever it is, I'm assuming it to be the same. It's not going to be that much. So now if you see this company, HDFC Bank becomes more, let's say, strategic in terms of how the movements will occur. So if let's say HDFC Bank moves up or down by 10%, it can have a higher impact than how Reliance moves up or down 10%. Right? This is the point that I was trying to make, that this is not only theory that all of you are studying, this is followed very practically as well. And free float market cap is used as a very strong indicator from a company's standpoint, right? Okay, students. So, in a way, I can tell you that HDFC Bank, the changes in the prices of the HDFC Bank share will impact more compared to the Reliance changes in the prices on the stock exchange. Okay, this is the nutshell that I was trying to tell you. Although to some of you, it might be that Reliance is a very big group, right? Even bigger than a single bank. They have multiple businesses, but still, their 50% of the holding is held by the promoters, right? Which will get excluded while calculating the movements or impacts on the indexes. That is why the concept of free float market cap exists today. Okay. Now let's come to the question number one from assignment. Reliable Industries Limited is considering a takeover of Sunflower Industries Limited. The particulars of two companies are given below. So Reliable becomes A Limited, right? In all our discussion, and Sunflower becomes B Limited. So RIL and SIL. RIL, earnings after tax, is given for both the companies. Equity shares is also given. EPS we can calculate, but it is still given. And they have also given us the PE ratio, 10 times and 5 times required. What is the market value of each company before merger? This is very, very easy. Second, assume that the management of RIL estimates that the shareholders of SIL will accept an offer of one share of RIL for four shares of SIL. So 1 is to 4, right? If there are no synergy effects, so they have clarified that there are no synergy effects, what is the market value of the post merger RIL? What is the new price per share? Are the shareholders of RIL better or worse off than they were before the merger? So, in the second part, they have asked us three different questions. One is, what is the market value of post merger RIL? What is the new price per share? And whether the shareholders are better off or worse than the previous merger? All the answers, all the formulas that we have already discussed will get deployed here. Now, in the third part, due to synergic effects, sorry, the management of RIL estimates that the earnings will increase by 20%. Okay, so the earnings will increase by 20%. What are the new post merger EPS and price per share? Will the shareholders be better off or worse than before the merger? So, three different parts are there. So, let's start with the solution, students. All the formulas that we discussed will get applied over here. Okay. So, first of all, let's start with the first part, solution. Market value of each companies before merger. RILSIL. Okay. EPS is how much? 2 and 1. What is the PE ratio? 10 and 5, right? To calculate the market price, we have been given EPS, we have been given PE ratio. Can we calculate the market price? The answer is yes. Market price per share will be EPS multiplied by PE ratio. Clear? Easy. So this becomes 10 into 2, 20, 5 into 1, 5. Equity shares are also given 10 lakh and 10 lakh. So total market value becomes 10 lakh into 20, right? So this is 2 crores. 10 lakh into 5 becomes 50 lakhs. So this becomes the value, right? Now they have already given us the swap ratio, right? 1 is to 4. Even if we were calculating the swap ratio basis MPS, what it would have been? 5 divided by 20, which is 1 by 4, right? Which is still 1 is to 4. Basis MPS I'm talking about, okay? But let's not go over there because this is already given. Now the second part, it is asking us to calculate the market value post merger. What is the new price or post? So in a way, it is asking us to do the post merger analysis on the RIL shares, right? From the RIL perspective. Post merger effects on RIL, right? See, first of all, students, what is the post merger earnings? We will just add up both of them, 20 lakhs plus 10 lakhs, right? This one plus this one. Sorry. So 30 lakhs becomes the total earnings. Number of equity shares post merger. So that will be 10 lakhs were the original number of shares. Correct, students? And for these 10 lakhs, 1 is to 4 ratio has been applied. So on the 10 lakhs multiplied by 1 divided by 4. Correct? Yes, 2.5 lakh. Very good, Oja, Ginny. So 1250. The total count of shares is 1250 on a earnings of 30 lakhs. So the earnings per share,
2.4.
very good, becomes 2.4. This is the post merger EPS. Post merger EPS, right? Then the PE ratio, we will take it as same, which is 10 times. See, this is we are assuming. Okay. Sometimes what happens, questions will tell you that post merger the EPS will become this, sorry, the post merger the PE ratio will become this much. So we will have to apply the revised PE ratio post merger. But here, since nothing is given, we will assume it to be the same. Market price per share will be 2.4 into 10, which becomes 24. And hence the market value will be how much? 24 is the per share price multiplied by 12 lakh 50,000 number of shares. This is how much? 3 crores. Right? And from this, if we reduce the pre-merger value of both RIL and SIL, RIL was how much? 2 crores. SIL was 50 lakhs, right? These ones 2 crore and 50 lakhs. So 2.5 crore if we reduce from 3 crore, we will arrive at 50 lakhs as total gains from merger. Okay, students, clear? This one is clear till now? So this is the total gain from merger. Some part of it is attributable to RIL shareholders, some part of it is attributable to SIL shareholders. See, the question is asking us what all things. One is, what is the market value of post-merger RIL that we've calculated, right? 3 crores. What is the new price per share that we've calculated? 24 rupees. And now the last part, are the shareholders of RIL better off or worse off? See, as of now, the total gain is 50 lakhs. Now let us calculate the gain of RIL and SIL. So apportionment of gain to RIL and SIL. RIL, SIL. So post merger market value. Easy to calculate, right? So what is the value allocated to the original RIL shareholders and original SIL shareholders? So here we had 10 lakh shares into 24. SIL we had 2,50,000 shares into 24. Clear? 2 crore 40 lakhs. Here it was 60 lakhs. And then less pre-merger market value, which will be 2 crore here and 50 lakhs here, right? 2 crores on account of the earlier pre-merger value and 50 lakhs of SIL on account of the pre-merger value, right? So the revised value became 2 crore 40 against 2 crore. Here for SIL shareholders, the revised value became 60 lakhs against the 50 lakhs kind of a value, right? So here the gain becomes 40 lakhs. Here the gain becomes 10 lakhs. Thus, the shareholders of both the companies are better off than before, right? Because ultimately, for both of them, the value increase has happened. Yes, Nisha, we can do that as well. If you split 50 lakhs into the swap ratio 1 is to 4, you will get the same answer. Right? 4 is for A and 1 is for B. I mean, 4 is for RIL and 1 is for SIL. Okay? You will get the same answer. Then the last part is if they are saying that there is a synergy and the earnings increases by 20%, then what will be the revised value, right? Post-merger EPS and price. We have to find out the post-merger EPS and price. So for that, we will calculate the post-merger earnings. See, the total earnings pre-merger is how much? 30 lakhs, right? 20 lakhs and 10 lakhs, correct? Multiplied by 1.2 to arrive at the synergy included post-merger earnings, which is 36 lakhs. And hence the number of equity shares will be the same 12 lakh 50,000, right? Because the swap ratio in this case is also 1 is to 4. These are the total number of shares. So the EPS becomes 2.88. The P ratio being same of 10 times will be used to calculate the MPS, market price per share, right? Which is 28.8 rupees per share, right? So the revised MPS and EPS is calculated 2.88 and 28.8. And again, in this case also, the shareholders are better off than the merger because even at 24 rupees itself, they were better off, right? So at 28.8, again, we can show the same analysis that we have done post merger EPS like this, right? So what is the market value? 28.8 multiplied by 12 lakh 50,000. That will give us the overall market value that we can divide between the RIL and SIL to show the benefits. I'm leaving it till here because it is just a repetition. And ultimately 28.8 is higher than 24, so they will have a higher amount of benefit, right? So yeah, students, I mean, this is the overall, let's say, structure or uh, discussion points, right, that we want to discuss. Now let's take a break of 10 minutes. Post that, we will continue with the further questions on the same topic. So we'll again reconvene at 8:40. from the assignment. Yeah. So question number 2 says C Limited and P Limited, both companies operating in the same industry, decided to merge and form a new entity, S Limited. See, this is one of the cases that we discussed, right? Wherein two companies will merge, lose their identity, and a new company will be formed. The relevant financial details of the two companies prior to the merger announcements are as follows. For C Limited and P Limited, they have given us the annual earnings after tax. This is rupees in lakhs. The number of shares outstanding and the PE ratio, right? Somewhat similar data that we have been given in the previous question as well. The merger will be effected by means of stock swap exchange of 3 shares of C Limited for 1 share of P Limited. See, obviously, if you see 1 share of P Limited will get exchanged for 3 shares of C Limited. That we will see once. The thing that I was trying to say is we will see it from the EPS or MPS, what is the value per share coming out to be, right? After the merger, it is expected that due to synergy effects, annual earnings are expected to be 8% higher than the sum of the earnings of the two companies individually. Okay. Further, it is expected that the PE ratio of S Limited shall be the average of PE ratios of two companies before merger. Now, see, in the previous question, I was saying that we have assumed the same PE ratio, right? Here, they have given you how to calculate the PE ratio post merger. Evaluate the extent to which the shareholders of P Limited will be benefited per share from the proposed merger. Okay. Yeah. So for doing that, we have to calculate the post merger matrices, right? Let's start with the solution. So earnings of S Limited. S Limited is the new company, right? This we can put it under rupees lakhs, right? Because everything is given in lakhs. That's why. So earnings of C Limited, we will take their combined earnings of D Limited, 10,000 and 5,800, 15,800, right, is the total. Now there is a growth at the rate of 8%, right, in this, which is 1264. The total earnings of S Limited post merger comes out to be 17,064. These are the total earnings for S Limited. Now the second part is we have to calculate the market value of S Limited, right, which is the new company. Okay. So the second part is market value of S Limited. Earnings 17064 multiplied by the PE ratio. Correct, students? Now tell me, what is the PE ratio over here? Students, what will be the PE ratio basis the guidance given in the question? What should be the PE ratio? It is saying average of C Limited and P Limited, right? Yes, Ojajini, very good. This is 8 plus 10 divided by 2, which is equal to 9. So if we multiply the earnings into PE ratio, we will arrive at the market value of S Limited. 153,576. This is the total market value of the new company. Very good, Ojajini. Then the number of shares to arrive at, we will have to take what is the swap ratio, right? So number of shares in S Limited will be computed as number of shares of C Limited, which is 4,000, number of shares of P Limited, which is 3,000, right? This we have computed how? Using the swap ratio, right? So this is as is, and 3 shares of C for 1 share of P. So this will become 1,000 into 3, right? So in totality, we arrived at 7,000 total number of shares. Okay, then gain to the shareholders of P Limited, right? Because finally we have to substantiate, evaluate the extent to which the shareholders of P Limited will be benefited, right? Now, of P Limited, this will be again rupees in lakhs, just to reiterate the notations. So, percentage of holding of shareholders of P Limited in S Limited. So if we see, P Limited is having a representation of 3,000 shares out of the total 7,000 shares, right? So this will be 3,000 divided by 7,000, right? So this is denominated, so this is denoted as a matter of percentage, okay? And hence the market value attributable to shareholders of P Limited. 3,000 divided by 7,000 multiplied by 153,576. Right? Which is 65,818.29. So this is the representation of P Limited shareholders in the market cap for the combined entity. Right? From that, if we reduce the market value of P Limited before merger, minus 58,000, right? 5,800 into the price, or let's say we have calculated into times. So 5,800 is the earnings into 10 times the PE ratio. We will arrive at the market cap of the entire company, right? Not per share, but for the entire company. And hence the gain to shareholder is 7818.29. Very good, Ojajini. 78.29 divided by number of original shares we are talking about, right? Because from P Limited's perspective, whatever were the original number of shares, those were the number of shareholders, right? And using that, we will give the per share gain or loss. Gain per share is equal to 7.82 per share. Clear? So just because of this merger into the new company, the shareholders of P Limited are able to enhance their per share value by 7.82, because now instead of 1,000 shares in P Limited, they have 3,000 shares in S Limited, right? However, on a comparable basis, they are able to generate higher wealth of 7.82 per share. Clear? This was what the question was asking us to calculate, and hence we have calculated the same. Clear, students? So let's move ahead to question number 3. Messrs. Tiger Limited wants to acquire Messrs. Leopard Limited. Yeah. Okay. The balance sheet of Leopard Limited as on 31st of March 2012 is as follows. So the target company's balance sheet is given, right? Equity shares, retained earnings, debentures, creditors, and other liabilities. So I think there is this piece of information that is missing here. You can just add 7 lakh here. Okay. So this is 70,000 shares into 10 rupees, which is 70 lakhs. Retained earnings is 3. So 7 and 3, 10, and 3, 13, and 3, 16.2. Yeah. So this is the total. Then similarly on cash, 50, 70, 2 lakh and 13 lakh is the plant and equipment. Clear? Then additional information, shareholders of Leopard Limited will get 1 share in Tiger Limited for every 2 shares. 1:2 is the swap ratio. So for every 2 shares held in Leopard Limited, they will get 1 shares in the Tiger Limited. External liabilities are expected to be settled at 5 lakh. Shares of Tiger Limited would be issued at its current price of rupees 15 per share. So they will be issuing the shares at the current price of 15 per share. Debentures holder will get 13% convertible debentures in the purchasing company for the same amount. So this 3 lakh will get converted into 3 lakh. Debtors and inventories are expected to realize 2 lakhs. So this entirely 270 will be realized as 2 lakh. Tiger Limited has decided to operate the business of Leopard Limited as a separate division. The division is likely to give a cash flow after tax to the extent of 5 lakh per year for 6 years. Tiger Limited has planned that after 6 years, this division will be demerged and disposed for rupees 2 lakh. So this is the terminal value that they have given. Okay. The company's cost of capital is 16%. Make a report to the board of directors of the company advising them about the financial feasibility of this acquisition. And they have given us, basis this 16%, what are the different present value factors from year 1 to 6. Clear? So, in a way, what they're asking us to calculate, they're asking us to calculate whether taking upon this company is beneficial or not, right? So, this is in a way we are in a mid of decision to invest or not, to acquire or not. And whenever it comes, the biggest evaluator, or let's say the biggest successful evaluator is this, to compare the cash outflows and compare the cash inflows. If the NPV, the KPI is called as NPV, if it is positive, that means you are having a higher amount of cash inflow compared to your cash outflow. Then you should go ahead and do the investment. So on a solution bit, NPV, we will make use of NPV, right, which is the net present value of cash inflow plus present value of demerger of the second division, right? Because it is also mentioned after 6 years it will be demerged, right? Present value of demerger of Leopard Limited business minus whatever is the cash outflow that we have done to acquire the company. Clear, students? Now the flow is very simple, right? Because we have been enabled by the quotient to calculate the cash outflow, right? And to calculate the cash inflow and the scrap, or let's say the demerged value for which the disposal will happen. So let's first calculate the purchase consideration. Okay. So it will start with the issue of shares. How many shares are we issuing? 1:2, right? So 70,000 are the existing shares. 1:2 is the swap ratio, and we will be issuing at 15 rupees per share. So overall, we are actually paying this much of consideration through shares, right? 15 into 70,000 into 1 by 2, which is 5,25,000. Then we will also settle the external liabilities. This will also go as a cash outflow, students, right? 5 lakhs. Then we will also issue convertible debentures, right? What are the rate? 13% convertible debentures, right? 13% convertible debentures, yes. 13% convertible debentures. This is again 3 lakh. 13 lakh 25,000 will be the total, right? This is what the outflow will be. But at the same time, while we acquire this company, there will be some inflows as well. Realization of debtors and cash. Sorry, debtors and inventory, not cash. Cash will be taken over as is. Realization of debtors and inventory, which will be this 2 lakhs. Less cash of 50,000, right? So hence the net cash outflow slash purchase consideration will be, yes, 10 lakh 75,000. Okay. So this is the net cash outflow, right, for evaluating this decision. And now we will calculate the net present value as, so 5 lakhs is going to be the recurring amount. So for 5 lakh, we will take the present value annuity factor for 16%, 6 years. For 2 lakhs, we will take the present value factor. See here, I am not putting A, PVF only, which is present value factor. Here it was A as well. So this is the yearly factor that got accumulated one, right? Present value accumulated factor or annuity factor, with whatever you want to call. This is 16% for 6 years minus 10 lakh 75,000. So this will give us the net NPV. NPV will be 5 lakhs into 3.684, right? Which is the addition of all these 6 different values, 0.862 plus 0.743, like that. Okay. Up to 6th year, if we do, this is the number plus 2 lakh at the end of 6th year, right? Which is 0.410 minus 10 lakh 75,000. So the NPV becomes 8 lakh 49,000. Since the NPV of the decision is positive, it is advantageous to acquire Leopard Limited. Clear, students? So this was a bit different question in the way the requirements were asked and the data was given to us. Clear, students? Let me just check for any queries if they have come uh, in the second handle also. Yeah, there are none. Students, please do let me know. I hope this is clear. We will move ahead. Perfect. So let's move ahead to question number 4 now, students. So C Limited and D Limited are contemplating a merger deal in which C Limited will acquire D Limited. Okay. The relevant information about the firms are given as follows: total earnings, number of shares, EPS, PE, and MPS. What is the maximum exchange ratio acceptable to the shareholders of C Limited if the PE ratio of the combined firm is 7? And interestingly, what is the minimum exchange ratio acceptable to the shareholders of D Limited if the PE ratio of the combined firm is 9? So if you see, now it is a question of deal, right? It's a question of who is willing to receive or pay how much. So C Limited is actually acquiring, right? So you will see that always C Limited would want to negotiate better by paying less or by issuing less or by agreeing to the swap ratio of a lower proportion, right? So they will always have an intention to go down. So whatever they will agree, they will say that maximum we can give you this much. Beyond this, we will not be able to give you. Similarly, D Limited is on the receiving end, right? Because D Limited is selling its business. So the shareholders of D Limited would want to maximize their let's say whatever amount that they are receiving, right? So they will want a minimum amount to be secured, and that is the way question is drafted, right? Acquiring company shareholders will want maximum this much swap ratio can be exchanged, and target company shareholders will say that minimum this much is what we need to sell the company, right? So let's evaluate from both the angles. So let's first evaluate the maximum exchange ratio acceptable to the shareholders of C Limited. So let's start with the MPS of C Limited, which is given in the question as 38.4. Number of equity shares is how much? 20 million, right? Yes. So I'm just putting here it as millions. This is per share. Okay. So the market capitalization is how much? 38.4 into 20, right? Very good, Ujajini. It is comes out to 768. Right? And then the combined entity is able to generate how much? 96 and 96 and 30 as their earnings, right? So this is 126. Combined market capitalization will be how much? 126 multiplied by what is the price earnings ratio of the combined firm is 7, right? That is what they have mentioned. It is 7. So this will become 882, right? So the combined is 882. Out of that, 768 was the pre-merger value of C Limited. So the maximum I can pay is the difference between these two, right? If you understand it from the acquiring company's standpoint, right? So minus before merger, right? This was 768 in a nutshell. This is becoming how much? 114. Net net, this is 114. This is balance available for D. I hope all of you are there with me till now, students. So this is 114 is the maximum that can be given by C Limited to the shareholders of D Limited. So this much equivalent value we are talking about. Okay. Now we have to arrive at the swap ratio, right? So for doing that, let's assume the number of shares to be something. It will be easier. Let's assume number of shares to be issued to D Limited be D. Okay. Let's assume that. And is the revised MPS after issuance of shares to the shareholders of D Limited is this is post merger, okay? 882 was the total market cap divided by 20 were the existing number of shares and D is the fresh issue of shares, right? Right? So this is the MPS and D will become what? D will become, for this 114 that we have arrived here, divided by the MPS of post merger. Okay, divided by the MPS of post merger. Right? Because maximum 114 is what we can give. So per share price, if we have, we will be able to arrive at the number of shares, right? Per share price we have calculated here. So 114 divided by 882 D plus 20, right? So this is balance available for D. If I rewrite it as balance available for D divided by MPS post merger. Correct? So here the equation becomes D is equal to 114 into D plus 20 divided by 882, right? If we solve this, D becomes 2.96875 million shares, correct? And hence exchange ratio becomes 2.96875 divided by, come on students, tell me whether should I divide by 20 or divide by 14? 20 or 14? Come on students, tell me whether should I divide it by 20 or by 14 to arrive at the correct exchange ratio. Yes students? Anyone would want to attempt? Again, I would encourage all of you to please reply. Even if wrong or right, there is nothing like that. So my question to you is, we are trying to calculate
Divide
the
by
exchange.
20.
Sorry?
Divide by 20.
Divide by 20. Okay. Any other answer or any other view? Okay, no worries. See, now there were two things here. Students, if you see, the way we have approached this question is, we have first calculated 114 is the available amount that can be distributed to the delimited shareholders at a maximum level, right? Now, that translates into how many number of shares? 2.96875 million shares, right? So that 114 million amount translates to 2.96875 million shares. Now, if you really see, this is the shares in the combined entity, right? So this is the shares in combined entity post merger, right? Now What is the swap ratio? Swap ratio is how much shares you will get in the combined entity versus what you have currently now, right? So logically, if you think through, what you have currently from delimited standpoint is 14, right? So because of this confusion itself, I just wanted to lay emphasis on this, that 20 need not be divided. Okay. So it should be divided by 14 because currently I'm holding 14 and I will be getting 2.96875, right, in the combined entity. Correct. I hope this is clear, students. So it will be divided by 14. Then it will become 0.212 is to 1. Clear? So this is the first part of the question, students. Yeah. Thank you, Pooja. That's what we have. The overall objective is okay. Thank you, Pooja. Yeah, Ojajini, you are right. 14. Yes. Okay, you mentioned 14. Okay, very good. I got the responses now, I think. Okay. Then the next part. What is the minimum exchange ratio acceptable to the shareholders of D Limited if P ratio of the combined firm is 9? Now here if you see, the entire calculation will happen from the perspective of D Limited. The first part we have started. What is the pre-merger value of C Limited? What is the post-merger value of C Limited? Whatever is the difference, that C Limited will be okay to kind of share it with the D Limited shareholders. But here the things will get into different order, right? So let's start with the second part. Minimum ratio acceptable to delimited's shareholders. So what is the market price per share of delimited? 15 rupees. Now all the statistics that we will write here is will be for delimited. 15 rupees is the market price per share. Number of shares is 14 million. 15 rupees per share and 14 million number of shares. The market cap becomes 15 into 14 million, right? So 210 million becomes the market cap. Then we will see what is the combined entities value. For that, let's take the combined earnings. 96 plus 30, right? Very good, Ujajini. 210 is the right answer. So 126 million is the combined earnings. Combined market cap. So this combined market cap will be basis the combined PE ratio of 9, right? So 126 into 9. Okay. So this is how much? 1134. Sorry. Now just to tell you, see, now practically what is happening here, practically this solution, the first part of the solution, this calculation is done by the acquiring company before acquisition. So they are doing this calculation just to see that, okay, where are we currently, what will be the combined earnings, and where we will go after that, right? And the second part is something that is done by the target company's management. So they are also trying to evaluate that where are we currently and what is there for us in the combined entity, and hence what should we ask for, right? What should we ask for? Okay. Then 1134 is the overall market cap, right? In this, if we reduce the market cap of delimited pre-merger, which is how much? 210. So this 924, this they will say that, okay, this will be attributed to the C limited balance for C limited, right? Because see, ultimately 1134 is the overall value. Out of that, 210 is our value, and balance can be for C limited. So this is what D limited is thinking. So ultimately, minimum to minimum, what is demanded by D limited? The demands of D limited is only 210, right? So the minimum they would expect to enter into this deal is they should get at least 210, right, worth of value in the new entity. Let D be the equity shares to be issued to shareholders of D limited. So here the revised MPS post merger will be how much? Because for that again we will follow the same logic. We will calculate the MPS post merger. So what is the, as per this combined PE ratio, what is the value? 1134 market cap, right? Divided by 20 is the existing one, and D is the new shares that are issued. And as I said that, now what will delimited shareholders think? They will say that out of this 1134, at least 210 should belong to us, right? In terms of the market cap. Clear? At least 210 should belong to us. So whatever are the number of shares to make it up to 210, we should be issued. So D now will become what? 210 divided by 1134 divided by 20 plus D. Right? So this is the minimum value expected by delimited divided by MPS per share post merger, right? So if we solve this, D becomes 4.54545 million shares. Now here the exchange ratio will be 4.54545 divided by 14. 0.325 is to 1. Clear, students? Now if you really see, so we have done the solution till here, okay? Now I'm just trying to discuss some of the key things in this. So C Limited is saying that we will be able to have a swap ratio of 0.212 is to 1, and D Limited is saying that we want at least this one. 0.321 is to 1, right? That is what they are saying, that much they want, right? So what is delimited saying, that if you do this, okay, it is 0.325, 325, yeah, right? So they are saying is, if you do this 0.325 is to 1, then we are not in any loss situation, right? But the deal will not happen, right? Because C Limited is saying that this is the maximum and D Limited is saying that is the minimum I would expect. So do you think the deal will happen? No, right? But have you seen any one more difference in the fact, the basis which this 0.212 and 0.325 has been calculated? What is the change of that fact? If anyone can just tell me, so that we will conclude this question. Okay, students. See, our objective is to understand the situations also, right? So in this situation, C Limited is the acquiring company, D Limited is the target company. C Limited is saying that I will be able to give you maximum of 2.1, 0.212 is to 1 kind of a exchange ratio. D Limited is saying that no, I want minimum of 0.325 is to 1 as per their calculation. So yes, there is no midway, right? Because C Limited is already quoting well below what D Limited's minimum expectation is. But my question to you is that, is there a change in fact because of which these numbers are seeing pole apart? Come on, students. You can just write it on the chat box also. You can speak up as well. Yes, there is a biggest factor, which is the PE ratio. Both the parts have different PE ratio. Here it is 7 and here it is 9, students. So this makes the real difference, right? Because both of them are doing this calculation basis the different P ratios. Had they agreed to a common P ratio, the numbers would have been somewhere closer, right? Let's come to question number 5. ICL is proposing to take over SVL with an objective to diversify. ICL's profit after tax has grown at the rate of 18% per annum, and SVL's PAT is grown at the rate of 15% per annum. Both the companies pay dividend regularly. The summarized profit and loss account of both the companies are as follows. So they have given us the net sales, PBIT, interest, provision for tax, PAT, and then dividend as well. Then they have given us the balance sheet position also. ICL and SVL, both the companies put together, fixed assets starting with land and building, plant and machinery, furniture. Current assets they have given minus current liabilities. They have given us the breakup or creditor, overdraft, provision for tax, provision for dividend, and then finally the net assets. And this net assets is matching with the capital employed, which is paid up share capital, reserves and surplus, and borrowings. Clear? And then they have given us the market price per share as well, which is 52 and 75. Can anyone tell me what is the difference between market price and book value per share? Come on, students. What is the difference between market price and book value per share? I'm asking a very easy question. Yes, MP is based on fair value. Very good. And book value per share is computed using the balance sheet or the balances appearing in the balance sheet, right? So they have given us the market price, which is the market phased number. ICL's land and building are stated at current prices. SVL's land and building are revalued 3 years ago. There has been an increase of 30% per year in the value of land and building. So here they are saying this one. Okay, this is basis the revaluation. 720 was not. Then SVL is expected to grow at the rate of 18% each year after merger. So ICL is taking over SVL, right? So SVL currently is growing at 15%, but they are saying it will grow after takeover at the rate of 18%. ICL's management wants to determine the premium on the shares over the current market price, which can be paid on the acquisition of SVL, right? So it is nothing but the price per share of SVL that they're talking about, right? So let's say the total price is 1000, the current market price is 800. So the premium that they will be able to pay is 200. That is what the question is asking us to calculate. You're required to determine the premium using net worth adjusted for the current value of land and building plus the estimated average profit after tax for the next 5 years. The dividend growth formula, and lastly, ICL will push forward which method during the course of negotiation. Okay. So they are asking us to calculate through both the different methods and then finally conclude. It's an easier one. Don't get, confused with the way the question is again asking. It's very easy and simple. Let's start. Computation of premium, right? See, it is asking us to calculate the premium using two things, right? One is the current book value method, and second one is the dividend growth formula. They have given us the dividends as well, right? So first use the first part, which is the book value per method. See, first of all, for the company in question is SVL, right? So the total assets value for SVL is how much? 550 and 580, right? So 1130, right? We are talking about rupees in crores. Yes, see. So 1130 is the total assets, less what is the liabilities? 240 is the total liability and 105 is the borrowing, right? So in totality, we are having how much? 240 plus 105. This is 345, right? 1130 minus 345 becomes 785. Perfect, Ojajini. 785 becomes the net worth. But this is not adjusted for the land and building, right? So this also we need to adjust. So the current revalued land and building, what is the current price? 190, right? And it is mentioned that are revalued 3 years ago, there has been an increase of 30% per year in the value of land and buildings. So this will be 190 into 2.197, right? Which is this one, 30% for 3 years, right? So the total value is how much? 417.43 less book value of land and building. Sorry, which is 190. So this becomes 227.43. So this is the net increase due to the land and building. And hence the adjusted net worth is 785 plus 227.43, right? Because this will, at the higher valuation will lead to higher net worth. So this is 101.1012.43. Then the current profits after tax will grow at the rate of 15%. So this 250 bases the 15% future value factor, right? For 5 years is how much? 250 multiplied by 7.7537, 1938.43, right? So average profit for 1 year will be 1938.43 divided by 5. So this 7.753, just for your understanding, it has come from here. Okay. So this becomes 387.69. Right. So this is the average profit. Now the way question is drafted, it is saying that net worth adjusted for the current value of land and building plus the estimated average profit after tax for the next 5 years that we have calculated. So the total value of the firm will be 1012.43 plus 387.69, which is equal to 1400.12. Total market value. What is the rate? This is basis the 75 share price, right? Correct. And just a second, where is the equity share capital? Yeah. And 12.5 is the face value, right? 12.5 is the face value, right? 125 divided by 10. So 12.5 number of shares into 75. This is the current operating market value. 937.50. So ultimately the premium is this much. Right? Premium is the total value calculated minus the existing market value, right? And in terms of percentage, this will become 462.62 divided by 937.50 into 100, which is approximately 49.35 percentage. So the company will be willing to pay a premium of 49.35% over the current existing value to arrive at the correct valuation. Okay. Clear, students? So the first part is clear, right? Now using the dividend growth model, right? Using the dividend growth model. See, dividend growth model market price per share is given as D1 divided by KE minus G, right? I hope you remember this formula. Perfect. So dividend that is expected to paid after 1 year divided by cost of equity minus growth. And there was an alternative formula also, which was if you rearrange this, so cost of equity will become D1 by MPS plus growth, right? This was the alternative one. So if we rearrange this, we will arrive at this. Correct? So existing growth rate 15%, right? The dividend per share is 125 divided by 12.50, right? So 125 is the current dividend and 12.5 is the number of shares, right? Paid up share capital 125 divided by 10 is 12 and a half. So that means the DPS is 10 per share. Market price per share existing one is equal to 75. So that means the KE, cost of equity, using the this formula, right? We can arrive at, yes. So 10 into 1.15, because 10 is today's dividend. We have to arrive at the dividend that is going to be paid after 1 year, right? So which is 10 into the growth, which is 15%. So 10 into 1.15 divided by market price of 75 plus growth rate of 15%. 0.3033. So the expected growth rate after merger will be 18%, right? Now the MPS will be calculated using 18%. Ten into 1.18 divided by 30.33, right? KE is 30.33 percentage minus 18 percentage is the growth rate, correct? It becomes 95.70. So since the growth rates have increased from 15 to 18%, see, ultimately, if you don't change the growth rate and you apply the same formula at 15% over here, you will reach at 75, which is the existing MPS. But why have you reached at 95.70? Because the growth rate has increased from 15% to 18%. That has led to the increase in the growth rates. So that has led to the increase in the market price per share. So the premium over current price, that is 75, will be 95.70 minus 75 divided by 75 into 100, which is actually 20.70, right? This comes to how much? 20.70 in divided by 75. Yeah, 27.6% students. Okay, so now if we just summarize this, so the first part and second part. First part, the premium was how much? 49.35. And here the premium is 27.60 percentage. Right? Now, if you see, using this method, the acquiring company, which is I think ICL, right? ICL, yes. Will pay more, right? And here the target company will receive more, correct? And vice versa will happen over here. Correct, students? So, if the question is drafted from whose point of view, let's see that ICL will push forward which method? ICL will push forward the second method, right? Because there is a lower cash flow in that. During the course of negotiations, ICL will push forward valuation based on growth rate method, as it will lead to least cash outflow. Clear, students? Perfect. So that was it from today's session. Today we have covered good discussion points on the mergers and acquisitions overall understanding, and we have covered till question number 5. So in the next session, we will cover the balance part, students. Okay. So yeah, I think let's conclude for the today's session. Thank you everyone for joining in. Thanks for your patience listening. Thank you. Yeah. Technical team session over.